All right, let's jump right in. Today, we're going to take a deep dive into Crocs, specifically their recent Q2 performance and what they're seeing for the future. You've shared some really insightful updates, and our goal here is pretty simple. Cut through the noise, pull out the key stuff, and help you understand what really matters in these developments. We'll break down each key update one by one, try to give you a clear picture of, where the company's actually headed. So, kicking things off with the Q2 overview, Crocs, Inc. actually had a pretty solid second quarter in 2025. They hit their highest ever quarterly gross profit.
Yeah, that's right. And the free cash flow was impressive, too.
Really impressive. $269 million. And they put that cash straight to work. $133 million on share buybacks. And another $105 million used to pay down debt. So fundamentally a strong quarter, wouldn't you say?
Absolutely. But what's really compelling here is that even with that revenue growth you mentioned, Crocs is making some, let's say, bold strategic moves. They know these actions will probably impact revenue temporarily in the second half of the year.
Okay, so not accidental hiccups.
No, not at all. They're deliberately pulling back on promotions, reducing inventory receipts.
Less stuff coming in.
Right. And they're laser focused on cutting costs, particularly for the HEYDUDE brand. It really signals they're prioritizing long-term brand health profitability, even if it means, a short-term hit to the top line.
That's strategic gamble, then.
Kind of, yeah. Betting that this short-term pain builds stronger brand equity down the road.
Okay, that strong foundation sets us up nicely to look closer at the actual financial numbers. So for the total company, revenues hit $1.1 billion.
Which is up 3% year over year, constant currency.
Right. Adjusted gross margin, 61.7%, a slight tick up. But the adjusted operating margin was 26.9%, so that dipped a bit.
Down 240 basis points.
But adjusted diluted EPS, earnings per share, that was $4.23. Up 5% year over year.
Okay, but here's where we see the impact of that strategic thinking we mentioned. The GAAP net income. It showed a significant net loss, almost $492.3 million.
Wow, okay. That's a big number. Why so large?
Well, it's primarily due to a non-cash impairment charge, $737 million.
Impairment charge? Explain that a bit.
Sure. It's related to HEYDUDE's intangible assets and goodwill. Basically, when they bought HEYDUDE, they assign value to things like the brand name, customer lists. If those assets aren't performing as expected later, or the market changes, accounting rules say you have to write down that value.
So it's like saying the HEYDUDE acquisition isn't worth quite as much on paper now as they initially thought.
Exactly. It's a reevaluation. But importantly, it's non-cash. It doesn't affect their actual cash flow, which, remember, was still that strong $269 million.
Got it. Still, it does raise questions, doesn't it, about the HEYDUDE integration and sort of the overall fit.
It absolutely does. It suggests maybe a tougher road for HEYDUDE than first planned.
Okay, let's shift focus then. What about the Crocs brand itself? How did it do? Revenues there were $960 million. That's up 4% year over year, constant currency.
And the adjusted gross margin?
Pretty flat, actually, around 64.1%. But the really interesting part is the regional split. North America revenues were down 6%.
Down 6%? Why is that?
Crocs attributes it to that strategic pullback on discounting, especially in their own direct channels. But internationally, that's where the story gets exciting. International revenues for the Crocs brand soared up 16% year over year.
16%? Wow.
Yeah. And it now makes up more than half the brand's revenue mix for the quarter.
That's a huge shift. Which regions led that?
China was the leader, up over 30%. Followed by strong growth in India, Japan, and Western Europe.
Zooming out, that strong international growth for Crocs isn't just about diversification. It feels like a pivot, almost, like the company's discovering its global identity beyond the U.S.
That's a great point. It shows that commitment to brand health over just chasing short-term sales, especially in those key international spots.
And product-wise, what drove that growth?
Well, popular clog variations like Echo, Bay, and In Motion were big drivers. And sandals kept performing really well. Styles like Brooklyn, Getaway, and Miami, the one that blew up on TikTok.
Oh, yeah, I remember that.
They showed notable strength. Personalization, too, especially Jibbitz charms. Wider distribution, better displays in stores helped that.
And marketing. Still digitally focused.
Very much so. Digitally led, social first. Still #1 footwear brand on TikTok Shop in the US. And they just launched in the UK, apparently with strong results.
Any big partnerships.
Yeah, successful ones with Cars, Pokemon, Minecraft. Plus, they're using those NIL athlete deals. Name, image, likeness to connect with younger, sportier crowds. So, Crocs brand booming internationally, but hey, dude, Bit of a different picture, right?
A bit, yeah. Revenues were $190 million. That's down 4% year over year.
Down, but wasn't that actually better than Q1?
It was, yes. An improvement. Suggests maybe some stabilization efforts are starting to work.
And their gross margin.
Adjusted gross margin was 50.2%. That's actually up 110 basis points year over year.
How'd they manage that?
Mainly through better distribution and logistics efficiencies. Getting smarter about moving product around.
Makes sense. What about sales channels for HEYDUDE?
Well, wholesale revenue was down 13% year over year.
Ouch.
Yeah. But direct-to-consumer, their own channels, that was up 7%, boosted by new store openings and, again, strong performance on TikTok Shop.
Okay, so what's the strategy for HEYDUDE going forward? What are they focusing on?
Management's really hammering 3 core pillars. First, reignite the HEYDUDE community.
Okay.
Second, drive the core product line, but also add carefully selected new stuff. And third, really prioritize brand health to stabilize that key North America market.
And product-wise, what's working there?
Iterations of the icons, Wally and Wendy, are doing well. Some collaborations too, like with Pabst Blue Ribbon and Margaritaville.
PBR shoes. Interesting.
Right. Also new things like the Paul Pro Refresh Socks, the Hey 2.0 Drain Shoe, trying different angles. Their Hey Dude Country campaign is trying to tap into music and that pre-post sport vibe. Awareness is up a bit in North America. Consideration too.
So trying to reconnect with their core audience?
Exactly. But the really striking thing is the aggressive action to clean and refresh the HEYDUDE marketplace.
Clean and refresh, what does that mean exactly?
It means literally taking back extra aged inventory from retailers, giving them more allowances for returns and markdowns.
Wow, okay. That sounds expensive.
It is. It's like cleaning out a cluttered garage, like you said. Necessary for the long term, but it definitely creates short-term sales headwinds. They also pulled back on some performance marketing to boost digital profitability.
Right. Okay, shifting to the bigger picture management strategy, they keep saying they're making bold decisions for the future.
Yeah, framing it as sustaining their durable cash flow, not just managing quarter to quarter.
And cost savings are a big part of that.
Definitely. They've actioned $50 million in savings, $15 million hit in Q2, the rest split over Q3 and Q4, spread across SG&A and gross margin.
SG&A being selling, general, and admin costs?
Correct. And they're looking for more savings there, too.
What about innovation, new products?
They see strong paths for new stuff, especially sandals, expecting good growth there into next year, planning more new clog and sandal ideas for Q4 and early 2026, plus expanding personalization beyond just gibbets.
And leadership changes.
Yeah, a few key ones. Terrence joined as chief brand officer for both brands. They added a chief strategy and growth officer. And interestingly, CEO Andrew Rees is personally leading the HEYDUDE brand efforts right now.
Really stepping in directly.
And it's crucial, I think, to see all these moves in context of the wider market.
How so?
Well, the U.S. consumer is cautious. Discretionary spending is tight. People are feeling price increases. This apparently hits the low-end consumer harder, makes them less likely to just browse in stores.
And retailers are feeling it too.
Yeah, retail partners are cutting back their open-to-buy budgets for future seasons. They're being more cautious with inventory orders.
Okay, and tariffs. Still a factor.
Oh, absolutely. The U.S. extended a pause on some incremental tariffs, but Crocs is planning based on current rates. They estimate the hit from those incremental rates could be around $40 million just in the second half of 2025.
$40 million.
And maybe $90 million annually if they can't mitigate it. That includes a hefty 50% tariff on products sourced from India.
Wow. Plus competition, right?
Big time. There's a noticeable trend back towards athletic footwear. Performance brands are grabbing attention and dollars.
Especially with big sports events coming up.
Exactly. World Cup, LA Olympics. That puts pressure on shelf space and those open-to-buy budgets we mentioned. Crocs feels they're well-positioned for pre- and post-sport wear, kind of casual comfort around activity.
But they admit losing some shelf space.
They do, yeah, in those core family wholesale channels, so it raises a big question.
How does this focus on brand health stack up against these macro headwinds and the competition?
Precisely. It's a really tough balancing act.
No doubt. So given all that complexity, what's the official guidance, the outlook?
Well, they're actually not reinstating full-year guidance right now.
Why not?
They cite the difficulty in really projecting the impact of, changing trade policies, unpredictable consumer behavior. Too much uncertainty.
Okay, but what about the next quarter? Q3.
For Q3 2025, they expect consolidated revenues to be down 9% to 11% year over year.
Down 9 to 11%. Okay. How does that break down by brand?
The Crocs brand is expected down mid-single digits, mostly due to North America declines, but international growth should offset some of that.
And HEYDUDE.
That's expected to worsen significantly in Q3, primarily because of those accelerated cleanup actions, the inventory reset, cutting back performance marketing.
Taking the hit now, basically.
Seems like it. And the adjusted operating margin for Q3 is guided to be between 18% and 19%.
Lower than Q2?
Yeah, and that includes an estimated 170 basis point negative impact just from tariffs and the effect of lower revenue on fixed costs that deleverage.
Okay, so let's try to pull this all together. If you connect it to the bigger picture, what are the main opportunities and challenges?
Right. So the opportunities, they have a diversified platform now, 2 distinct brands. International growth is accelerating, especially in Asia and Europe. They're leaders in digital and social commerce, particularly TikTok Shop. Product innovation continues, especially in sandals and personalization.
And cost savings.
And proactive cost management, definitely. Key opportunities.
And the challenges.
They're significant. Macro headwinds, cautious consumers, cautious retailers. The ongoing tariff impact is substantial. HEYDUDE stabilization is taking longer and costing more in the short term than perhaps expected.
Plus competition.
Increased competition from athletic brands, yeah. And those intentional strategic revenue pullbacks create their own headwinds. It's a complex mix.
But despite those headwinds, they seem focused on shareholder value.
Very much so. They highlighted deploying $2.4 billion over the last decade to buy back about 30% of their shares.
And just in Q2.
Repurchased 1.3 million shares for $133 million. Still have $1.1 billion left on their buyback authorization.
Plus the debt paydown.
Right. Paid down $105 million in Q2, keeping their leverage within their target range. Management clearly stated they think the stock is an excellent value.
So the bottom line, what does this all really mean?
Okay, I think it means Crocs delivered a solid Q2, fundamentally strong gross profit, great cash generation. They used that cash wisely for debt reduction and buybacks. But they face pretty significant near-term headwinds, especially in North America.
Yeah.
Cautious consumers, plus their own strategic choices to protect the brands and deal with tariffs. These actions mean revenue will likely decline in Q3. Management argues, though, that it's necessary for long-term profitable growth across both brands.
And that HEYDUDE write-down.
Yeah, that significant non-cash charge on HEYDUDE, plus the ongoing tariff issues, really underscore the challenges of integrating acquisitions and just navigating global trade right now.
So what does this all mean for you, listening? Maybe think about how a company tries to balance taking these short-term financial hits against trying to secure long-term brand health. It really is a strategic tightrope walk, isn't it? This deep dive kind of shows all the complex pieces involved in running a global brand today.
Yeah, and it raises a fascinating question, I think. How do these tough strategic decisions, even when they hurt in the short run, actually reshape a brand's resilience and its competitive edge over the next few years? It's a real case study in adaptive strategy.
Definitely something to think about. Okay, before we wrap up, just the standard reminder. We are not financial advisors, and this content is only for educational purposes. If you are considering making any investment decisions, please be sure to consult a certified financial advisor.